Hey, you guys, I'm Phil Town for Rule 1 Investing, and today I want to talk to you about how dividends fit into the 3 things that a CEO can do with your money as an owner of a business. So first of all, what exactly are dividends? So dividends are an allocation choice from the CEO. CEOs can basically do 3 things with your money, essentially, right? So if you own the entire company, dividends are one of the 3 things a CEO can do with their capital that's coming in from you as an investor. So one of the things they can do is they can pay a dividend, which I'll talk about in a second. Another thing they can do is they can buy back their own stock, which I'll talk about later. And the third thing they can do is allocate that money, invest it in the business to grow the business. So dividends are one of those 3 things. Dividends are a distribution of the company's equity, right? The company, theoretically, the company's earnings, but not all the time. It's basically a distribution of cash out to the shareholders, the people who own it. And that was decided by, the recommendation of the CEO. This is how we want to allocate our capital. And then the board of directors approves that dividend. In other words, a dividend is money that the company you're invested in pays out to you directly in cash. Really pretty straightforward. So for example, let's say a company pays a 2% dividend. Now what that means is, based on the stock price today, somebody's looking at that and going, the stock is about $40 a share, and the dividend is 2% of the $40, so that's like 80 cents, right? In other words, you'd usually say, here's the company's paying out this 80 cents over the course of a year, 20 cents per quarter, and I could buy the stock right now for $40, so I've got a 2% dividend. All right, pretty simple. So what is the appeal of investing in a company that pays a dividend? Because there are people out there who just think that is just the coolest thing in the world, is to just, buy companies that pay dividends. My little brother's one of them. He really loves to buy dividend-producing companies. And the obvious reason is that they pay the owners of the business, the shareholders, real money, real time. So dividend stocks, companies that are paying this out every 3 months, rain or shine, this becomes a very reliable source of income. And a lot of people like to live off of it. And that's what my little brother does. So in fact, in the Great Depression, a lot of people thought that the only value of stocks was the value of the dividend being paid out, because the stocks were certainly not going up. They had been cratered, right? At least that's what they thought. It turned out not to be the case. Now, another way to look at dividends is a simple return of capital, which can help lower your risk. So if you get the dividend, this money's coming into you. That's money coming back out of my risk investment. I paid $40 for the company. I got 80 cents of it back this year. And each year I'm getting back a little bit of that investment, which is reducing what we call a basis. So our basis is what we got in the stock, and as our basis goes down every year because we're getting this dividend, our risk of investing in that company goes down every year too. So if the dividend is really high, let's say, I've got a company right now I'm making a dividend of about 10% a year on. That's pretty good, right? And that means every year I'm reducing my ownership basis by about 10%. Wow, that's great. In 10 years, I've removed all of my money off the table. That's awesome. Now I no longer have any risk in the company. I've got all my money off the table. Now I'm playing with house money. It's like when some people go to Las Vegas, they got their $1,000 that they're taking as a bankroll, and they put it out on the table, and they start winning. They're going to take their own money off the table. Till now, they've got $1,000 of the house money up there, and they're just playing with house money. That's kind of what we want to do. It'd be awesome to use a dividend that way. Be awesome because why? At the end of 10 years, it's really hard to say that we've lost any money in that investment. We've got our money out of it. So dividends can be a way to reduce your basis, get your capital off the table, lower your risk. Those are all really good things. Now, you might be thinking, this sounds like a pretty good deal. And it's true, that can be a really good deal. It's a right thing to think about. But when we look at dividends another way, we're going to look at it differently than a lot of people do. If you've been following the basic principles that I've been teaching you guys on this channel, you know that we don't look at our investments as simply buying some stocks. Instead, what we're doing is we really do research, we carefully research, we look for a wonderful business that's well managed, that we understand, that has a competitive advantage that's unique and durable, and that aligns with our values. That's what we're trying to get. And we wait for an event that's going to happen that creates fear for short term. And when that happens, this company goes on sale, we buy it on sale, that gives us a nice margin of safety. So this is awesome. So that's what we're trying to do. Now, we do that whether the company's producing dividends or not. Doesn't really matter. What we're looking for is a wonderful business, first off. But if the company you invested in is checking off all of these critical boxes, that you understand it, it's got a big moat, good management, and we're buying it on sale, right? Then if they don't distribute their capital out as a dividend, what are they doing with it that we like in that wonderful company? And what they're doing with that money, that they're not distributing as a dividend, is they are reinvesting that money to further grow their business. And that is going to allow our business, right, the one we own, we got to think about it like that, that's going to allow our business to grow and increase the value of my ownership. And ultimately, that can be really a lot better than taking the dividend in if I don't need to get it for living on it, right? I'm going to get a much higher result in the end. So it's amazing how this can grow. So while dividends can seem kind of enticing, a really great Rule 1 company is often one that reinvests that money in itself, allocates it to growth, and continues to grow that wonderful business. Now, just to give you a flavor of that, if I'm getting the money in, and let's say it's a 6% return on my investment, that's one thing. But if they kept it and could make 30% the next year on my money, oh man, I would much rather have them do that. So dividends are awesome. They are fabulous. Let's be very clear about this. I love a company that produces great dividends, but I love even more a company that reallocates that capital in a way that grows the business at a huge return on equity. That's what I want to shoot for. I like to see 20%, 30% or more return on equity, return on invested capital, and then I know my investment's growing at that huge rate because the stock ultimately will keep up with what the return on investment is. So another thing that CEOs can do to allocate capital is buy back their own stocks. Now, we actually kind of prefer that over receiving a dividend, because if they do it right, it increases our ownership position in the company dramatically. Now, here's how it works. They're going to take money that they could pay me as a dividend, and instead of paying it to me, the CEO notices that his company, which is worth, let's say, $100 per share, is selling in the stock market for $50 a share. It's massively on sale. And when that happens, if he can take some of my equity and buy out some of the other owners of the company, that's called a buyback of their stock. What happens is they're buying out my partners at a really super low price. So they're paying $50 for something worth $100. And what that means is every single partner that sells out, every single shareholder that sells out is making my position larger at a super good price. It's a little bit like if you and I own a restaurant together and you suddenly are getting divorced and now you've turned into a raging alcoholic and your whole life is going down the tubes and you're going like, please just give me money, I need money right now. We have that restaurant appraised and it's worth $1 million. We each own half of it. So your half is worth $500,000 and you say, please, I'm desperate to get the money right now. I'll sell you my half of this thing worth $500,000. I'll sell it to you for $250,000. Yeah, I'll take that deal. Okay, so that's how buybacks work if they're done right. Unfortunately, a lot of CEOs don't do them right. What they do instead is buy back their stocks all the time, whether it's high or low or anything in the middle. And that's just crazy. So you got to know who the CEO is, how well they allocate capital, and then you hope that they're going to allocate it properly. If they're not at a really great price of their stock, then they should pay you a dividend if they don't know how to reallocate the capital to grow the business. So those three things are really important. You can allocate capital, grow the business. That's my first choice. You can buy back stock if it's on sale. That's my second choice. And if you can't do either one of those, then send me my money. All right, those are the three things we're looking at. So now I'd love to hear from you guys. Do you have any additional questions about how dividends work and whether it's the best thing or just one of the good things? Leave a comment below with your question and I'll be sure to follow up with you guys. Thanks for watching. Now go play. If you guys enjoyed this video and you think it was valuable in teaching you more about how dividends work, hit the like button and be sure to share the video with your friends. And if you want more investing content, got a lot of it on my channel, just subscribe to it. And don't forget to click the button on the screen for a free gift. And thanks again for watching.